In project finance, I keep harping on the fact that there are kind of 6 things about debt sizing. I used to say 5, now I say 6. How big is the debt size, how we borrow money during the construction period, how we repay the money, and refinancing related to the repayment. So that's 1, 2, 3, 4. What are the interest rates and the fees and the cost of the debt, and finally, what's the all the credit protections and credit enhancements. Now, in this video, I'm going to talk about debt funding during the construction period. And I'm going to skip this time. Maybe I can do it like this. So, oh shoot, excuse me. So we're going to talk about debt funding. And in the past, I've kind of done something a little bit bad. You know, I started when I did all this teaching, I started with some Harvard case studies. And one of the most famous Harvard case studies is this Petro-Zuata case. All right, and in that case, there is a little thing, a sources and uses statement. And in the sources and uses statement, they put operating cash flow as on the equity side. You know, interest during construction and fees are capitalized, so they're a reduction in assets. The same sort of cash flow, so pretend you made interest income on a bond, which they did. You would have capitalized that and put that here. The same interest income, if it's just a reduction in assets, it doesn't count for very much. But if it's equity, and you count this as equity, so it looks like the debt percentage is much lower because you have this operating cash flow, that's a really big deal. And it's all related to accounting. It's only a big deal, by the way, if I keep harping on this fact that there's either the DSCR is driving you or the debt to capital is driving you. It's only a big deal as debt to capital. So let's review the kind of basic project finance. I changed my green and red arrows. The green is where everything comes from. That's what you really have to understand. Some green comes from the sponsors. Some green comes from the lenders. The lenders want to get paid back. The sponsors want to get paid. You have to pay all these other people. Okay, now what we could do is, let's say we had multiple projects. Now imagine this is multiple wind farms, multiple solar projects, 2 stages of a combined cycle project, you know, any of these kind of things. We could put all these projects in as separate SPVs, and then project 1, the equity, the dividends, could be used to fund the green line in project 2. Project 2, the green line, I should have started with the green line, really, should fund the red line, blah, blah, blah. And that's what happens, no big deal. That's just another place to get equity. You could give your dividends to shareholders, the corporation, or do whatever you want with them. But now let's put the projects in one separate SPV. If we put the projects in one separate SPV, and then they're staggered, they're not, this one starts at a different date than this one, and this one, and this one. The interesting thing is that from an accounting perspective, project 1, 2, and 3, 1 has some income, 2 has some income, 3 has some income, and then we can be calling this income equity. And does it make a difference whether we take dividends and fund the project, or is it better to put the projects in a consolidated basis and do this? Now, the other question that comes up is what happens if you have multiple projects and there's some variation in cash flow and variation in cash flow? Does the combination of the projects protect the lenders? Is there a portfolio effect from this? So I'm going to show you, I'm going to demonstrate some modeling issues associated with all of this. All right, now I'll get into the model. And in the model, essentially, in the model, there are a few rules in making this model. We'll make project 1, project 2, project 3, and in the model we're going to put them all together. And I'm going to try to address some funding issues, and I'm going to have a couple of videos related to this. In the model, we're going to put as many as 7 different projects together. And when we do that, we'll be able to start our projects at different dates and put in different construction periods and development periods, and even kind of put in different prices and EPC costs. Now, eventually, we'll also put in some volatility and some Monte Carlo simulation. That's going to be in a separate video. Okay? Not too big a deal, really. Now, the first issue is what happens if we, in the first case, let's just have all the projects go in all at one time. Then we'll stagger the projects, so this one will produce some income and cash flow, and we'll be able to test which is better. Is it better to have an IRR from separate projects or consolidated projects? And what are some of the accounting issues? Now there'll be a few mechanics. I'm going to start by just showing you a few issues. Okay? First of all, we better have a consolidated page. So far, I've only got nothing but a timeline, but the timeline is crucial. This timeline, that's the crucial one. Number one, it's going to be very difficult to do this timeline on anything, the analysis rather, on anything other than a month by month by month, a very fine timeline, short periods, because we're going to consolidate. And if we, start to have a consolidated project that has semi-annual periods up here, or worse yet, our single project that I'm going to describe in a minute has single periods, that's going to be hard to consolidate. I'm sure it's possible. It's probably not even that hard, really. But I'm going to, just to illustrate that, we're going to do everything on a month-by-month basis. And that's our objective, to show, does it matter because of this accounting stuff to consolidate this or not? Now, very, very quickly, here's our model. We have a timeline. We have a start date, and we make it really, really flexible. A decommissioning date, a development date, a COD date, a death date, a decommissioning date, I said. We can put an initial lease or an initial PPA agreement if you're in electricity, or whatever you want. I put an idle period. And then we put this thing, well, how many days do we have? And if we're doing this a month-by-month basis, we just take the days and then do a days 360 to see how much we have in the pre-COD period, and we can put a month-by-month or a year-by-year in all of that, so that getting the timeline is right. And then, I'm going to talk about this later in a next video, making a spark line and making a construction S-curve that's really flexible, and making it use the NA function, and so we can, and making it real flexible, so this graph that you show in the spark line varies when you change the construction period. Okay, that was, for me, an exciting thing to do. Sorry about that. All right, with the Weibull function. And then we put in our price and our quantity, and on the debt side, everything comes from a sculpting on this one. I just put sculpting and pro rata. And we put in our construction expenditures, and after we put in our construction expenditures, we go to the sources and uses of funds statement as usual, have a summary sources and uses of funds, put our debt, repayment, no refinancing in this one, sorry, it should be in every one I said last time. Then we put our repayment on a sculpted basis, and finally some depreciation, which is going to be a big issue, and a cash flow waterfall, and DSCR. Now, I have forgotten to put a couple of inputs. So we can put all of these inputs in one place. What we can do, what I think is a kind of general rule, in addition to a timeline, I should put, number one is a timeline. Number two, put all your inputs together like this in kind of a little, and name the range. This is called data input range. And then use the input, use the index function, and I think I still have to put in three inputs: the target DSCR, the tenure of the debt, and the interest rate. And I kept it simple because we want to focus. And the idea is, I didn't keep it as simple as I perhaps should have, but I want to focus on the real issue, this accounting issue, and the consolidation issue. So if we have a number here, this is from the 10th row, and then I want to put in the don't worry about this, I put the number here. Let's put in excuse me, I'm not really explaining this. The DSCR is row 13 in this range. In this range, I tried to figure out if there's a way to kind of color ranges. It's got close, but not there. Maybe somebody else can do that. But so in line 13 is where the DSCR, and this is for project 1. So in project 1, at the very top, maybe I should have put it here, all the way at the top, but I put it here. That's our project number. Okay, and then to get our data, I'll put 13 here, and then it worked, but I'll put equal index, and let's put the data input. I just tab, and then the row input is this one, and the column input is that one at the top. It's the 13th row in the first column. And that's how, I hope I did this one. I did all of these. No F4s. Well, I was wrong. The F4 should be on the column, because then we can change all the columns. Sorry about that. And then so the tenure is, all we can do is put, I hope that's 14. Let's see if it is. And all I could do is copy this and paste it here. And then, of course, we have the repayment date, which takes the COD and multiplies it by 12. And then I copy the interest rate, and it gives me a value. But I've said, oh, no, that's 15. Shift Control P, because I have my generic macros open. That's all. Then Alt E M. And I'll move it to the end and create a copy, and I'm going to call it Project 2. Okay. And then all I have to do is now change the row number to 2, and then let's just change one thing in let's say our start date is in 2018, and we have 50 months, okay? So by doing this little index thing, which is for real estate a big deal, you can put multiple projects together. And then we can put in our different development period. All just works with the index function, okay? Now the next thing I might want to do is, if I have this project number 2, I would like to get the outputs of this project number 2, and the outputs I want to get are the project IRR. Now I put this in as number 1 output. The second thing I'd like to get is the debt to capital ratio. The third thing I'd like to get is the equity IRR, so I put this as number 3 because I might want to insert a row later, and then the minimum DSCR. So to get and put all of these together, now we're going to use the indirect function. Now I don't know, you could kind of put these all on one sheet and not need the indirect function. Then of course you only need it if the indirect function works best if there are some things in the same. In this case they're all in the same column. We could even insert a row. So if I want to show the IRR for all this, I want to find this was in column I first put a match. And we matched, this was number 1, and we matched this against, I'm going to use project 1, I'm going to say they're all the same. Again, it doesn't work so well if we've got different formats, and this just gives me the row number, the match. I have been saying, oh, we only need 3 functions. I think you really still need match and index. Okay, and then I always say you need index, and then you put indirect. And what you can do is just go, let's go to first, well, we've got a space, so we got to go fast. Double, inverted comma, single, double, and sign, project 2, F4 twice, and sign, double, single, exclamation, I, close, and sign, and this row number F4 3 times. And then we have it. Okay, and I guess this is Shift Control 1, and then if I have 15 as the construction period instead of 25, then it's just changing this project and nothing else. So I'm going to put it back to our original one, and I'll put this one back to our original one, and then we have the same project terms. And now all I'm going to do is copy this, and I'm going to pause the video. You don't have to watch me copy it and do it for all 7 projects. Okay, so I copied the files. I've done that and did something very, very important. And I recolored things. So each one has a different project number, and that's the way how all of these inputs just can come directly from that number. Okay? And as long as things, and I just press Alt-E-M, and that's all. And then now let's just do a little bit of consolidation. Now I'm going to say that perhaps we want to make things nice and flexible, and perhaps we only want to select some projects and not others, and see what happens if we add one project and don't add the other. That's not really that big a deal. The only problem with this is when you make your little boxes, and I've talked about this before. Right now it goes into 16, and we have to right-click and manually put this into, this should be number 8. I said 16, I think I meant 6. This should have been 7. So there's that program I showed you where you can just make, it's kind of like our little generic macros, where we can, if we have a whole bunch of these, in this case it's really not that difficult, where we can just go down and it's just a little macro to do them all at the same time. Okay, now let's get our standalone equity. So let's get the equity cash flow. Now, to do this, I think I'm going to copy the project numbers down here. I can put them over here. And all we have to do is, let's do it in one thing. So we'll put lookup. Of course, we put lookup. And again, I'm repeating, but the idea is this timeline has to be big enough to cover everything. So we go to project 1. You do it with the start of the period because you always want the ones. And then you go down and you just find the equity cash flow. And anybody who still uses match and index is just a snob. It's better, it's a lot faster to use lookup in a financial model. Okay? And then because of the NAs, because we made this so long, we can put if error, and we'll put a 0 it out if we're not in the timeline, which is just fine. Okay? And now the only problem here is that we have project 1, 5, 5. So what we could do is put the row number, it's always going to be 5. So I think we can hold that, but we can put the 210 here. And then just use the indirect function again. And on this one we put, so as soon as we see this, we say indirect, and we put a double quote, single quote, double quote, take this project 1 out, double quote, and sign, click on project 1, F4 3 times, I think, and then another and sign and double quote, and then we have single quote, and we can say that it's always going to be 5. And we might want to really do that. But then just press enter, make sure it still works. And then we do the same thing over here. Indirect. And you double quote, single quote, double quote, and sign. You get the idea. I need to click there. And then F4 3 times, excuse me, and then we put an and sign, double quote, double inverted comma if you want to say it. And then if we really want this, oh shoot. And then we put another double quote here, and this time we can put an and sign and go to our, let's remember, we probably need 2 of those. Then we can go and press the F4 key 3 times here, and then an and sign, double quote, double, double, and sign, double like that, F4 3 times. Ooh, there we go, and there, and then Shift Control R, and there's our cash flow. And the good news, I couldn't press. I keep pressing Shift Control D. I'm sorry about that. And then we can Control D it. Okay, and I suppose I need to copy this one down too. And it didn't quite work, but I'm not despairing. I forgot the most crucial F4, which was on this one. I hope you saw that. And then okay. And we get, right now they're all the same. If we go up and change the date on this one, let's make this one start in 2018 again, then on our consolidated project, we having it start later. And I'm a little worried right now because I don't think I went far enough, so I've got to pause the video and just kind of fix this thing. Okay, after putting the cash flows in, let's first do this. Remember, this was the indirect function to get the project IRR. and DSCR and all those actuals. Now we put the identical inputs in. I hope we're getting the identical outputs from each separate project. Then we put all the cash flows together. If you're going to use the XIRR, of course you have to put this horrible minus 0.0001, if whatever, if you have a 0 in there. So we compute this, we add them together, and then do the XIRR, and this 11.37 is the same as this line. Oops. As that line. Okay? No big deal. And then we can even change the dates. So let's put equal E date and maybe go 12 months into the future. So each one is staggered now. And this consolidated, this IRR stays the same, which it should. I would be sad if it didn't. And now you could say, oh, no, well, there's still negatives here. But by the time you get to some of these, we have some positive, a little bit of positive dividends that are able to fund this one. And who really cares? With the IRR, it doesn't matter where it's coming from. And the IRR does not depend on the timing, when the project went in, or if you have a bunch of zeros at the end or zeros at the beginning. At the beginning, I remember years ago I had a very nice man who just didn't believe that if you put zeros at the end and zeros at the beginning, it didn't matter. It doesn't matter. Okay, enough. Now, after we do this, let's get some things from our other projects. Let's get what we always need is. First, maybe the EBITDA of all our projects. I didn't put in, by the way, the true or falses here. You know, of course we could put the trues here and look at me just kind of, and then multiply all of these by this true F4 3 times. Okay. And then, again, that's the advantage of using this indirect function. We can put it all together. And now what I can do is take these, I think I'm not going to take the true falses, and we just do almost the same thing. And hopefully, if I go to project 1, I can just find the EBITDA up here, this in line 106. And why don't I do it like this? Now, it would be, if you have different row, you could put row like this and go to line 106. So if we happen to insert some lines later on or delete some lines, whoops, we'll do the same thing here. Okay, if you're even fancier, maybe you could do a match and find the EBITDA and make it really flexible. That would be by far the best. And then we'll copy this, Shift Control R, and hopefully our first EBITDA way down here, because this is monthly, it's not going to occur for a long time. I think I did something wrong. Just a minute. Oh, I have to put the trues here. Okay. I shouldn't have done that. Okay. And I hope we can kind of see if it's catching everything. Come on. Here we start with our EBITDA. Okay, and it's just so once you have the first one established, you can copy it across. Now, after we put EBITDA in, I think perhaps we should separate the development expenditures and then somewhere down here put the construction expenditures, and then now, once we have these fundamental parts of our business, and I think we're going to need the depreciation expense. That's going to be a big issue. Okay, those are all from our pure, unfinanced kind of cash flow. Then we can start and make a sources and uses of funds. And the reason I'm doing this, and we put uses of funds, and then, of course, the development and the construction, and then we better put IDC, and we could put DSRA and everything else in, but that's kind of where I stopped. And we'll put total, and then we put sources of funds, and the big deal here, when we consolidate these things up, we'll put debt, contributed, equity, and finally we'll put income, PCOD. When I say PCOD, that's going to be the project COD, and we're going to need a little bit of we're going to have to define everything that's pre-COD. So part of this EBITDA that we compute will be pre-COD, and part of it will be post-COD. And the reason I put the depreciation expense is that's now a really, really, really big deal. If we subtract depreciation expense, we have a whole lot less pre-COD income. But if we decide, no, we're not going to start depreciating this project until the COD, the project COD, then we don't subtract it. And then we're going to have more income that comes pre-COD. And then we put our total, and then we can do our funding, and then we can put our debt balance in as usual, and then the cash flow waterfall, and finally our equity IRR, equity cash flow, and let's get our equity IRR, and let's also get our DSCR. And that's basically what we need in any model, and that's kind of a fundamental skeleton of any model. And what I'm going to do is not turn the video off while I do the essentially copying and collecting all this data using these little code numbers. And when I come back to you, I hope to focus, and I hope to end this video and focus on the real issue, which is, does consolidating staggered projects increase our IRR, and what kind of nuances, like the depreciation and how much we make and how we set our debt to capital, whether it's by sculpting or by just a target debt to capital, how all that affects the conclusion and our strategy about consolidating projects or keeping them in separate SPVs. That's the real issue. Okay. After, I don't know how much, perhaps an hour, I'm back. And you didn't see this, but I put in, we used the indirect function, and we added all up these, and then just to review some very basic modeling ideas, we first put in a sources and uses of funds. Now, unfortunately, we just had this horrible, disgusting crapola copy and paste, very easy to make copy and paste. And then right now I made a scenario where all the inputs are exactly the same. All the start and end, so we have no pre-operating cash flow. Now, what I had to do to get this is to say, okay, let's take the very last COD. Let's go down and take the very, very last date at which we're putting everything together. That's our last COD. And let's make this debt percent consistent with all of these debt percents. Okay, and then we'll put the same debt tenure, whatever, in, and we'll get the end of the debt. So we've got some kind of consolidated assumptions. And then I suppose we can even put, I don't know, we'll call that consolidated assumptions. And then we put our equity cash flow, get our EBITDA, our development cost. And this is something you would do no matter what. No matter if you had, you know, a couple little wind farms together or something like that. Then I'm financing this on a consolidated basis. So we add up all our construction that's consolidated, all our IDC. Then the interesting thing is this pre-operating cash flow, which is the EBITDA over this period. Now, I have to do something essential. We better color the sheet so you know we can see what's the true and false, which don't we have to do that? That's so important. Okay? Oh, good. I was a little... Okay, now, oh, look at that. Okay, and then we go down to our funding, and we do a period-by-period funding, and I put a very simple pro rata construction, so once we start, we can see how we're funding all the expenditures, and then we have a debt balance, and the debt balance is kind of a normal debt balance, but because I'm funding it with the debt to capital ratio, we had to compute the PV of all the CFADS only over the loan life. Okay, and then we divide that by the debt, which we computed already upstairs. We've already done that, the debt up here. And then, so we take that and find the DSCR, and look at that. It's the same as the other one. I had to admit I had a little problem with that. And then we put our interest expense in, or our interest, and we allocate that between IDC and regular old interest expense, blah, blah, blah. We get the CFADS first. I didn't do anything fancy with taxes or interest income or anything, so we have no circular reference from that. Good. And then we have our net cash flow and our dividends, and on a consolidated basis, we get exactly the same as we did on a single basis. Now is where it gets so exciting. Now, if you would then, let's just start doing this a little bit late. Let's just say, okay, I'm going to put 5 months between each one. So I made the little e-date function, just use the 5 months. So then because we're using that index function, we get it all to be separate. And now, unfortunately, I have to do this horrible button because I didn't put the circular reference in, which I might do later on. And then we get a little bit higher IRR. And the reason we get a higher IRR is because this time we have some pre-commercial operation cash flow. And that means we have to put less equity into this, and it affects the IDC and everything else. And I assumed this pre-commercial cash flow right now was just the EBITDA. If it was the depreciation, which wasn't very big, so I'm going to leave that out. We'd have to kind of add back the depreciation. We could put that in. The depreciation, you could certainly make an argument that this should be after tax and after depreciation. That's where it would get a little bit trickier, and I'm not going to do that right now. Okay? Now, if we made this 12 months, so we have a even more staggered cash flow. Now that might not be realistic because your one project's half dead before the other project's starting to open. Oh, horrible copy and paste, really. Then we get an even bigger effect. I'm going to put a 5 months here. But now let's assume that the first projects are much more, we kind of finish them really fast. So we get our cash flow, and then we're kind of just sitting there waiting to get the last one done. Then what we're doing now, this is, let me put the back to 12 to make, sure it works. And I just want to do something kind of dramatic on this one. Suddenly now, oh my gosh, we're almost doubling the rate of return. Now, you can see what it is affected by. It's affected by which one's earning first, which one's earning second. But each time, if we can go down here and take and put some of our income as a pre-commercial cash flow, which is, income. Now look how we hardly contributed any real equity. Now we got to be really careful because this is affected by the timing. Because what's happening is you're still contributing some equity up front, and then it kind of goes up and down. So that's how it works, and it's, for me, that was okay. I'm kind of happy with this. It depends on how many projects you have, what the timing of all the projects are, and eventually I'll add a circular reference user-defined function to this. Okay, but for now this is enough, and it's been a pretty long video.